welcome to the participant to today's online seminar on the topic Restraining Dividends and Other Payouts. This online seminar is organized by many institutions today, so we are very welcome to do it together with the CEPR, the Florence School of Banking and Finance, and the Leibniz Institute for Financial Research, SAFE, at the University of Frankfurt, the Goethe University. My name is Elena Carletti. I'm a professor of finance in Bocconi, and I will be chairing this debate. So let me welcome the speakers of today in the order in which they will appear in the webinar. So first, we're going to have Francesco Mazzaferro. Good morning. He is the head of the Secretariat of the European Systemic Risk Board, and he will present the recommendation that the ESRB just issued on the topic. Then we're going to have three, let's say, discussants, if we want to call it this way. The first one is going to be Sylvie, who has been a member of the European Commission High-Level Forum on Capital Market Union, but also former regulatory head of Deutsche Bank, as we know her from the past. Then we have Acharya, who is a professor at New York University Stern School of Business, but also a former Vice Governor of the Central Bank of India. And then finally, we are going to have our partner, Representative Pieter Krahnen from the Goethe University and SAFE and the CEPR. So the rule is that Francesco goes first, as I said, for about 10 minutes, and then the other three have a sort of 5 minutes each, and then we are opening up discussion among the four of you, and then we are opening up the debate with the participant. Concerning the participant, the rules are the ones that we usually adopt, which is you can write your questions in the Q&A chat box that you can see at the bottom of the Zoom screen. And please try to ask brief questions if you can, and if you want to address them to a particular speaker, please indicate so. So without further ado, given that today we have an hour rather than an hour and 15 minutes and we are many speakers, let me give the microphone to Francesco for his initial remarks, please.
Thank you very much, Elena. Thank you very much for the invitation. The first thing I would like to check is whether you are able to see the slides. I've been trying to upload them.
We see the slides and we hear you very well. Thank you. Thank
you very much. There is some building work below me, so if you hear some noise, there is this really impossible to control. So going rather fast, it's obvious that we were confronted as from March with a situation which was evidently going in the wrong direction. At the beginning, also in terms of liquidity in the markets, and the first things which we wanted to do is how to act in the realm of our mandate to prevent it would evolve into a systemic financial crisis, something which I think probably not only because of us, but because of action of many authorities, we have been able so far to avoid. So the idea is that the financial sector must be part of the solution, not of the problem. I think this is to a large extent happened. And this is a bit different with the great financial crisis of 10 years ago. What we wanted to do is to strengthen the various segments in aggregated terms is our mandate. We don't work only on banks, and we speak only in banks to a certain extent in a proportion of what is their importance to the European system. Importantly, also, we wanted to take action to avoid that central banking instruments are the only games in town. So if we must end with the situation that everybody comes on their knee to the ECB to ask access to the facilities, then we have been doing something which has not been functioning. Now, what we have been doing is that in a very intense way, intense phase of work, we have been issuing a number of recommendations, not only on dividends, but also on the role which fiscal measures should have to support the financial sector, on prudence in asset management, on the question of procyclicality, and also an excessive margin in centralized and decentralized clearing. But of course, today we are discussing on distributions, and fundamentally, we were worried of one word, stigma. Because stigma can force financial institutions to take decisions which would weaken them and bring them in exceptional difficult circumstances. By the way, tendentially creating a situation in which then in a couple of years, or even before, would have to be recapitalized. The other point is, of course, that fiscal resources are not due to be spent to support the financial sector now. We have a problem of the economy, we have a problem of the households, but we do not have a problem I mean, we do not have a great propensity, at least, to spend money for the banking sector or for other parts of the financial sector. Obviously, also, it's not time for a short term, and as bank capital should be there and it should be available and should be used in case of materialization of unexpected losses. Of course, one of the issues on which we were mostly worried was the risk of widespread bankruptcies across the board, which could materialize, could certainly still materialize in the second part of this year or in 2021. And of course, it was also a bit of an ethical reason supporting prudence and self-restraints at the time of a very, very deep recession of uncertain duration. Now, trying to look at the different financial segments for banks, the argument is very straightforward. We need a stable credit provision to viable corporations. This is what I think also from the policy point of view, authorities have been stressing a lot, governmental authorities, European authorities. This is also the reason, by the way, why we as macroprudential authorities and also the microprudential authorities have released capital buffers to a very large extent, doing it at the right time in sync. And what we would like to achieve is that this money is used to lend, and that the banks do not shrink the balance sheet. And this is basically the argument why we are encouraging banks to refrain from voluntary payouts, dividends, bonuses, and share buybacks. But it's not only a question of banks, because we have been looking a lot at insurance corporations. This is one of the, at least in my case, of my passions. And of course, in the case of life insurance in particular, we knew that how much life insurance is now affected by two shocks, which are basically creating a sort of double hit. We invented the double hit wording at the time in which we started to do adverse scenarios for stress tests for insurance sector in Europe. The lower for longer scenario for interest rates is clearly now prolonged. And on the other hand, there are important exposures to government bonds, to non-financial corporations, and the real estate on the asset side, which could be repriced. This is the reason why EIOPA itself had already asked the insurance industry to exercise prudence in the distribution of dividends. Going beyond banks and insurance, we have been also including central counterparts in our recommendation. We know, of course, that there is a system of waterfall, that capital is only part of it, and this type of things. We have been working extremely intensively on CCPs. On the other hand, we are also aware that additional own resources would be important and are important to meet non-default losses. We are in a situation of a very important operational risk. We are all working from home. I'm working from home to write notes. So the people working in CCPs are working from home to move an enormous amount of money in situations which is very, very delicate, and including also because of risk from cybercrime. And in any case, we think that including criminals in the skin in the game and in the default waterfall on a voluntary basis is what would be useful in a situation of higher market volatility. Now, there are also areas on which we have not included economic agents in our recommendation. Also to explain that we have been looking at this very, very cautiously and also according to a principle of proportionality. In particular, we have not included asset managers and pension funds. The business model of asset managers of pension funds is different. Fundamentally, they receive their income from fees. and they distribute market profits to the unit holders. So that basically, if we had been saying to suspending payments of profits, they would have been basically suspending the profits, not to their shareholders, but the unit holders. And this is the reason why we have not been including them in the recommendations. Now, we took this action, which in our framework is as a soft law institution, is the most important, the most binding one. They are not binding per se, but they are subject to act or explain procedure. We did it on the 8th of June, after having worked on this basically for the full, basically April and May months. And basically we have been doing in the spirit of supporting the initiatives of our members of EBA, EIOPA, of course ECB, SSM, and the national authorities, all people who are at our table, and also to strengthen the case for a uniform approach across the union and across the different segments of the financial sector when it makes sense. The key features is that it is a recommendation which is addressed to competent and macroprudential authorities. By law, we can address recommendations only to our own members and to the public institutions, not to industry participants, not to firms and so on. It is also extended to the United Kingdom during the transition phase, and it is also extended to the European economic area, so also to Norway, Liechtenstein, and Iceland. It's basically covering all the institutions which are subject to the CRD, to Solvency II, and the CCPs, and basically it seeks to suspend the distribution of dividends or in the revocable commitment to make a dividend distribution, buyback of ordinary shares, and or any obligation to pay variable remuneration, of course, only to material risk takers. So it does not make sense. I mean, if you want to give a bonus to a guy who has been, let's say, defending the company in a situation of extreme stress during COVID, I think they have certainly a good right to receive a higher pay. It applies both at the EU consolidated level and, where appropriate, also at sub-consolidated or individual level, however, subject to a set of principles which are linked to the idea of dialogue. This is, of course, linked to the issue of home host. You certainly have read the fact that there have been some countries which have taken actions to restrict dividends at their national level, and this may have created discussions and issues which we have been trying to deal with. We have been referring very much to proportionate approach. We have also, and this is the last but one bullet point, we have been taking account of those situations in which there may be legal obligations already existing to distribute dividend, and in this case, our recommendation could not and should not override them and apply at least until the 1st of January 2021. I am aware that I'm already 1 minute beyond what is expected, so I will be extremely fast. What is special to the ESRB recommendation? Well, of course, it's written in macroprudential terms. It covers the entire 2020, so it goes beyond what was proposed by EBA and ECB and the EIOPA before. It has a common approach to all segments. As I told, refers to home host, and it has also obligation which concerns the variable remuneration, so it's a bit broader than the others. What is next? And I'm finished. Well, we will get info about implementation. And then, of course, we will have to see what is needed on the basis of implementation. I'm finished. I'm sorry, I've been 2 minutes too long.
Perfect, Francesco, don't worry. This has been a very clear presentation and a wonderful setting up the stage for the discussion. So
thank you.
Please, Sylvie, the floor is yours.
Very much.
If you just one question, if Francesco could maybe take out the slide. Yeah, thank you.
I
Please
did.
go ahead. Wonderful.
Thank you, Elena, for this introduction, and Francesco for the presentation of the ESRB proposal. I think that I have a few comments on that proposal. First of all, it seems real common sense to limit payouts in time of crisis, and in particular when public support has been received. That being said, I think we should be very careful in terms of both scope and duration of this type of limitation, because it goes with some risk, according to me, which may have the exact counter effect of what is expected. I see two types of risk. The first set relatively minor, and so I will begin by this one in order to put them aside quite quickly. The first type of minor risk is first of all a risk for the supervisor itself. You said, Francesco, that it was not binding, but a kind of soft law. And in fact, you run the risk that banks clearly don't want, banks or other financial institution, insurance, don't want to comply. And then you may have in return some risk for the reputation risk for the supervisor itself. I mean, that's for them to look at it, but I think it's not negligible. The second kind of minor risk that you alluded to as well in your slide is a stigma effect. Given that it's not something that will apply across the board because it's not binding, then you may run the risk that the bank who will decide not to pay dividends, for example, may suffer from a stigma effect on the market, and the market may think that it is a sign that this bank is quite weak in terms of capital. So that's some type of risk which I think are not negligible, but are not the same, the most important one for me. Of course, the most important risk is also from a macroeconomic perspective, that with that type of restriction or recommendation, I'm afraid that you may have a short-term effect, because as a short-term you keep capital within the institution. That's absolutely true. But on the other hand, you give a signal to the market, and you need to be very careful not to put the financial sector in a non-investable environment, because when you are investors, you may choose between different type of investment, and in the financial sector, you may be faced to a situation where you are not able to make sure if you're going to have a return on your investment or not, because this type of decision, which is a regulatory decision, is not able to be, it's not in the hand of the investors, it's not in the hand of the market, and it's something like it's very difficult for any investor to price and to predict. So you need to be very careful that this type of short-term of measure has a good impact on the short term, but may have a complete counter effect in the longer term, making the investors quite reluctant to invest in the financial sector because of that. And I see that as particularly relevant in terms of the current crisis, given that it can be expected that some institutions may need to go back to the market at one point and may need to tap investors. So, I mean, I think it's really a major risk, and you need to be aware of that. There is also another risk that you may also have think about when you mention asset manager, for example. So you need to be careful who is going to be penalized by this type of restriction. And if you look at investors of financial institution, you may find also some pension fund, for example. And if you restrict the dividends that you pay to pension funds, in return, those funds will not be able to give back to their client the return that they were expected. And it also can have a macroeconomic impact. So I guess that's something that you need to look at as well. And lastly, and that will be my last comment, this type of restriction may also have an impact on the business model of some financial institution. If you think in particular of banks who may have a business like an equity derivatives, this type of restriction has a huge impact on the profitability of this segment of activity, and may have an impact as well on the profitability of banks which are engaged in that type of activity. So it's something that may look common sense in the short term. My only comment is be careful at the longer term effect, which may have a macroeconomic impact, and for which the most important is to make sure that you don't give a wrong signal to investors that might be needed in the future. Thank you.
Thank you very much. Very clear and very on the point. Viral.
Thank you, Elena. Very good morning from New York, and good afternoon to everyone in Europe. I'll focus first on banks and then say something towards the end on non-banks. My own take based on the evidence we have from the global financial crisis and the Eurozone sovereign debt crisis is that once you are in the midst of a crisis or a severely stressed situation, it's never too late to ask banks to issue capital. And it's never too late because typically by the time you have reached this situation, you are late. By the time risk has materialized, stress has materialized, even as of now, the stress tests are not so severe that you would have seen or factored in a COVID-style shock into these calculations. Now, the point that Francesco made is very important, that banks, even in a situation like this where preservation might be an important priority for them, will not go and issue capital or raise economic capital or regulatory capital on their balance sheet. There is stigma, it would be the kiss of death for the first entity that goes out there and does it. And that is where regulatory coordination can be tremendously helpful. If regulators do it by fiat, then no additional signal is revealed on any one individual institution. Now, the counter argument that's given to this logic is that, oh, the regulator will send a sign of panic in the market by saying that all our institutions have to restore their capital. I think it doesn't quite cut. I think we have a brilliant example from the 2011 stress tests in Europe, where that is exactly what the regulator tried to do a stress test, but then say everything is hunky-dory when it wasn't in the markets. And the stress tests failed miserably. So I think that the truth of the data and the evidence is that when regulators show decisive coordination to restore capital levels of the banking sector, the macroeconomic state improves. When they resist to do this, actually they create signs of fragility and lack of confidence in the financial sector. I think this is the first point I want to make, which is that while clearly some individual entities, investors may be better off with payments of dividends, that is erosion of capital for the system as a whole, both for survival as well as for intermediation, and that the focus right now should be on altering the macroeconomic state of the world. The last thing we want in the midst of COVID is that investors are concerned about financial stability as a whole for the banking system. Now, let me touch a little bit on the specific point of should it be in the form of restricting dividends. I think this is an important point, and I agree with Sylvie that there is something that we have to be sensitive to, which is who are the bank's shareholders, why have they got into these positions, and in some sense, what might have been some of the implicit payout contracts with equities. Of course, it's not a fixed payment, so that, but there may be some implicit payout contracts. I think there is a simple way around it, and let me propose that, which is that the focus first and foremost should be on capital levels. We do stress tests in order to determine whether there's loss absorption capacity and whether there's capacity to continue re-intermediation and intermediation well in the banking sector. So take whatever balance sheets these entities have right now. Let's say we do a stress test and we come up with some capital levels. Now, how banks raise this capital, whether they do it through issuance of new equity, they do it through saving of dividends. They do it through cutting back on bonuses and variable pay. I think that could be left to the institutions as long as there is credible commitment sought from them that they will maintain the capital levels at the standards that the regulators want. There is, of course, an important point of sequencing, which is that they can't just pay out dividends and then, essentially force the regulator to bail them out. So it has to be a credible capital plan that has to be put in place. But that would be my preference, which is that rather than doing a micro management of whether it should be salaries, bonuses, variable pay, dividends, just ask banks to meet the capital levels that the regulators want them to meet and leave it to the banks and their shareholders to figure out how they should actually achieve this. Usually the sign that you are restricting dividends is a revelation that the regulator is not keen to ask the banking sector to raise capital. Now, if that is so, then I think we have to restrict dividends. But I think otherwise, I would say the preference should be to ask banks to raise capital. A third point, which is that I think we have to seriously worry about dynamics here, which is that we are in the midst of a large macroeconomic risk, even though there are signs of revival of economic activity. It can't be taken for granted as of yet. There are important second waves in several parts of the world. We have public balance sheets that have become bloated, not just over the last 10 years, but especially in the last quarter. Geopolitical risks are on the rise. And let's face it, we are openly telling the corporate sector, the SME sector, that we are not going to allow you to go into bankruptcy immediately for a variety of good reasons. So we have to entertain a stress scenario in which this doesn't play out well. And you have to allow for the possibility of letting some firms go bankrupt down the line because there may be no other choice other than to permanently put them in coma or a zombie status. This may also be necessary if there is a reallocation across productive sectors of the economy in the post-COVID phase or in a continuing COVID stress phase. So clearly the banks may have to take losses on these loans, some of them from legacy problems, some of them from the new problems that COVID may have started. And if we don't recapitalize the banking sector to absorb these losses and bear them well right now, when will we? Because clearly if we wait 6 months and the scenario is bad, there will be no option on the table other than to expand the public balance sheets to them because it may be too late. Right now, equity markets are doing remarkably well, in my view, given all the economic, monetary, fiscal stimulus. And I think this seems the perfect time to ask them to raise capital. So I would just do it ASAP without any hesitation. If restricting dividends has to be part of it, great. But I think we can just ask banks to meet a certain euro amount of capital that each bank has to raise, maybe either based on a stress test or something like that. And then one need not worry about its composition. One last point on non-banks. I think this is a great issue that Francesco has raised. I think financial stability is not just limited to banks. It can be about shadow banks and certain kinds of institutions in that space. Now, pension funds, insurance companies are, of course, more stable in terms of their liabilities compared to banks, who are typically more reliant on short-term finance. Nevertheless, what we saw in March of this year is that if their risk-taking capacity reduces significantly, markets can freeze and shut down, or at least behave in a fairly disorderly manner. Even even something as a safe haven like the US Treasury market actually did not function that well for about a week during that period because there were leveraged positions that were being unwound at a very, very rapid pace by hedge funds and others. So I would say certainly a systemic view can be and should be taken. What exactly the legal mandates are to regulate these different entities is of course a policy question that must be looked into. But I would say that if we are willing to extend the safety net to a set of institutions, or if we are willing to backstop markets where insurance companies, pension funds are playing an important role, we need to think about whether at the time we support the market, the regulator should acquire some either implicit or explicit right to actually maintain the stability of those institutions. Because otherwise, by backstopping the markets, we would simply be extending the safety net to non-banks. And then the risk-taking problem of socializing losses gets larger and larger. But overall, I support the ESRB initiative very much. I think capital retention is the first step. I would say capital building should actually be perhaps an even bigger, ambitious goal. And if one is doing that, then capital retention is a subtext rather than it being the primary tool. Thank you.
Thank you, Viral. Very clear, very interesting. Jan.
Yes, so I agree with a lot what Viral just said. So I think capital is really the word that and the entity that we would like to keep at a certain level. But I disagree with respect to the idea that we should restrict payouts so that retention is the rule or the idea of the moment that the regulator has to impose on financial institutions. I'm now speaking about payout restrictions as being imposed on institutions, not about payout institutions which are deliberately chosen in exchange for getting some funding, right? So, and that's how I understood the ESRB proposal to go really and impose it on institutions. I think this is a bad idea because it would, for a very long time to come, change the expectations of markets about what equity in banks really are. Is it still an instrument, a residual claim of what is basically being distributable after a certain time has elapsed in a financial institution that can be distributed to investors, or is it something else? It is a claim that can be, in discretionary terms, being changed in its value by government intervention, right? And that's a very different thing. Pricing is very different. And the willingness to give money is also changing. So my main fear would be if we define equity in a similar way as a mousetrap, we will see mice trying to avoid to get into that trap. Right? And that is what I think investors would think about. Just to give you a few ideas what this would mean. First of all, if we would impose dividend restrictions now, we must expect that once these restrictions are lifted, banks want to carve out as much as possible, always. So rather than keeping a balanced view on buffering their own cash holdings, their own equity holdings in a crisis, they will always try, as long as they are allowed to carve out the money, just to preempt, so to speak, the next step of the government that would restrict it. That's exactly contrary to what we want to achieve in a critical situation, in a crisis. Second, we have set up with great energy in Europe the project of the banking union. So I now speak about Europe, the BRRD, and its idea of creating a special insolvency law for banks, for larger banks, that really takes into consideration the liability of creditors of the bank. So bail-in is a very important part of that. So this construction that really builds on the idea of market forces, of market discipline, is of course hampered or impeded if we start to interfere in a discretionary way in these contracts, and particularly on the equity side. The banking union project, if it would work fully and would be implemented fully, would actually respond to an excessive distribution of dividends by increasing the price of bail-inable debt. So there is a market response that partly offsets the tendency to distribute equity in an excessive way. And this market response we would, of course, disturb if we intervene in the way that is suggested. So to make my point in one statement, I think we have opted for a regulatory regime in Europe which tries to define capital levels, and then banks are basically free how to reach them. and how to maintain them. And we should not interfere with this market-driven concept by discretionary limiting the rights in a particular financial form on in the equity side. Okay.
Okay, thank you very much. We have heard now very different views. Before giving the microphone back to Francesco for his reply, I don't want to try to summarize your many points because there are too many, but let me just highlight a few of them that are sort of common to some of the questions that I've already read on the Q&A. So first of all, the point that Jan just raised, but also Sylvie in a way, what do you think about market expectation? I mean, how can we make sure that this measure that maybe in the short run, as Sylvie was more favorable, is necessary? How can we make sure that this is really a one-off? This is not going to be, let's say, a measure that is going to change market expectation, as Jan said, or as one participant said, is going to be recurrent. So how can we make sure that the market doesn't think that the next crisis, we're going to use dividend restriction again? Because then really the problem of the banking sector in Europe, or also other sector, like the insurance sector, becoming uninvestable comes up much more, if you want, dramatically than if it is just a one-off question. The second question that some of you touched upon, but one Q&A again, is why have we restricted only dividends and not payment on AT1 instrument, which is a little bit the bail-in idea of Jan. Why have we somehow restricted the instrument on which such restrictions is applied? Third, we have been talking about the importance of considering bank shareholders. As you, Francesco, said, pension funds have not been asked to restrict dividend distribution themselves, but they are, of course, a shareholder of banks, and as Sylvie said, then they are indirectly penalized by this. Some participants even say shareholder of banks, in some cases, take, for example, Italy, are also foundations. They are also play an important role in society. What about them? And as far as I know, I believe that banks, or at least some of them, when they have restricted dividends payment on the 2019, at the same time, have extended free loans to foundation just to allow them to continue doing their social role and their macroeconomic, if you want, role that they normally do. Well, maybe not so macro, but at least social. Fourth, I think we'll go back to Viral. How do we think about capital versus dividends? Do we want to just think of asking banks to maintain a certain level of capital, doesn't matter how they reach it, versus restricting dividends? In addition to what Viral said, the banks are very heterogeneous. So as he said, we should do a stress test, but even if we don't do a stress test, some banks have a very high capital buffer right now. Some others are more stretched, and we have been imposing, or we have been asking to impose the restriction across the board for all banks at the same time. Is this correct? Because in a way, some banks are better positioned than others to withstand the shock. Let me stop here, and let me give the microphone back to you.
Thank you very much. I'm not sure I will be able to answer to all the questions. I will try, but let me start with a general comment. If we are doing all of this, it's because we are in a quite tragic situation, isn't it? So, and in this situation in society, there is always somebody, and today there are many, but many who are in deep trouble. So honestly, I'm very sorry for the foundations. I'm very sorry for the pension funds if I'm not able to get the dividends. But I'm also very sorry for millions of other people. And it's extremely difficult to find a solution in this situation, which is accommodating all needs. So the story is, how do we avoid a tragedy? How do we stabilize the system? How do we create a situation? So how to avoid that we would be, because of a competition, which is going in the direction that we have to distribute dividends isn't it? We would be in a situation in which in a couple of months from now, we are discovering that the distribution of dividends has been fundamentally weakening the financial sector. Because this seems to me the real point. The other one is that there is no great material difference between having this in October or at the end of January of next year. At the very end, we are still in the framework of the short term. So what we are discussing are short-term measures which are helping to stabilize the situation. We are permitting to governments to use their instruments, fiscal instruments, to, let's say, to function in a way that you avoid the complete collapse of society. We are discussing about GDP losses of unprecedented nature. And then we will see where we are. Of course, when we will see where we are, we will probably speak about distribution of losses. We will not discuss about distribution of dividends. So that's, I mean, we should be very, very clear. So it's not that we are doing these things one-off because we wanted to do a social experiment. We are doing the things on because we wanted to avoid a crash. And then when we will be there, we will have to see what to do. So in this sense, I'm not so much worried about what will be happening in the next crisis in 10 years. I really don't care in this moment. I have no time to think about this. My problem is to understand what we are going to be able to do in 6 months, 1 year from now. Okay, so this. So I appreciate all the general arguments, but I would like to ask all of you to do an exercise of realism. An exercise of realism, because all of us, we are confronted with an extremely difficult situation. And in this situation, it is impossible to believe that all those who are expecting something will get it. Unfortunately, not. Unfortunately, not. So then a couple of our issues. I don't know from the point of view of investors if whether would have been preferable that dividends are distributed and then banks have to be recapitalized. I really don't think so. So investors, by the way, are not stupid. So they know what is the rule of what is the situation in this. Whether they would consider the banking sector investable or not, most probably, by the way, does not depend on our measure. It depends on the structural issues, the profitability, the reforms. It depends also on how our society will be able to respond to this situation of stress. On the positive things, I think that investors are giving, they are perceiving the fact that public institutions, national and European institutions, have been able to respond much more than in the past to the crisis. So this, I think this, and then if investors are reasonable, they will expect to get dividends in the moment in which the situation will be stabilized. I would consider completely out of common sense that the investor would come to us now to ask if he's doing this. I'm sorry, it's not a good investor. It's not an investor in which you can count in the current situation. So these are a bit the general comments I wanted to do. I was not able to follow all the things because I was listening more to the other speakers. The question, I mean, in general, of course, as macroprudential authority, we will continue to make use of stress tests. This is our bread and butter. ESRB has been producing the adverse scenarios for all the stress tests since now many years. So the first one was in 2011. We are preparing to do it for EBA and the IOPA for next year. So obviously, what we are doing is not suspending at all stress testing. And I also don't think that we have been giving any signal, implicit or explicit, that we do not want to have the BRD functioning. Of course, there is a question, and I think this is an issue which is going beyond what we are discussing. There is a fundamental issue on which we are ourselves asking questions, which is the fact, what is the role of banks in the medium term? Now, what we have seen is that we need banks, first. Second, what we have seen probably, that the fact that the European financial system was more bank-based than the US has helped us a lot. So if you think about the huge interventions which the Fed was forced to do because of the dependency of the US financial sector from financial markets. So this was less needed in that case. Of course, the problem is what you do with the banks which you need if these banks are not viable. And this, I think, is an issue which we will have to address, and I'm sure we will discuss. Thank you.
Thank you, Francesco. Very clear. I don't think that any of the speakers or the participants wanted to sort of downplay on the difficulty of the situation. I think this is take this question not as criticism in the hard bone of what you're trying to achieve. I think that there has been a huge appreciation actually of the policy responses in general, I believe, of the crisis. Jan and Viral raised their hands, but then I also go back to Sylvie. Let's go in reverse order. Jan first.
Yes, one remark. It was interesting to hear what Francesco said about accommodating all needs. That's not possible. Of course, we don't want any authority to decide on that either. So now my main point is, if in such a situation a bank would pay dividends or huge amounts of dividends, then probably that would be respected and allowed for by markets, which have to develop to provide their debt financing at the same time, if and only if they expect a bailout to happen. I think the most important thing is now that the authorities make clear there will be no bailout, but rather there will be bail-in. So I would emphasize the role of the SRB in this situation. One should strengthen the SRB. One should make clear that we are able in the European system to deal with the weaker part of the banks. We need a restructuring anyway, rather than trying to make banks artificially stable. Not paying dividends is only artificially strengthening their situation in the end. So that's why I think we should reverse, so to speak, the argument, push for resolution and rather than for not paying dividends.
Thank you. Viral.
Thank you. I just want to stress 2 points. I do want to underscore what Francesco said at the outset, which is that financial crises, first and foremost, are not the hardest on bank shareholders. They are the hardest on the low-income people of the society. And I think that's just a given. If you look at the world, financial crises are the hardest on weak countries. They are not so hard on the developed economies. So I do think that the focus right now has to be on financial stability as a macroprudential goal. It can't be individually on specific investors. I'm totally with ESRB on this point. We never worry about taxpayer transfers to bank shareholders when we start giving out large bailout and public support packages. We do it by just flipping, we just do this and we announce bailout packages overnight. So I think we can't have this just one way. It's not a one-way street. Bank shareholders can't just keep getting public guarantees, bailouts of markets, and the put option that comes with it, without actually being asked in return to sometimes suspend capital erosion for short periods of time, say 4 quarters, 8 quarters, until these crisis episodes evolve. But I would say, I want to make an even stronger point, that this is actually not even to the detriment of the bank shareholders. Let's take the SCAP exercise of the United States, which were the stress tests done during February to May of 2009. We had gone through at least what was the greatest global financial crisis of our times. Bank volatility, market volatility was still very high. All arbitrage relationships across markets were dysfunctional, showing that things had not returned back to normal in January of 2009. United States announced these stress tests. They evaluated banks. $75 billion was asked to be raised by banks by June of 2009, more by some banks, less by some banks, and none by some banks. Actually, the announcement of the stress test results and its credibility changed the macro state of the financial sector for the US economy and the global economy. Investors reduced their risk aversion, all volatility measures came down, and banks, because the macro state improved, went and raised $200 billion of capital on their own, far beyond what the banks were actually asked to do by the regulator. And I think this is what we need to focus on. We are right now trying to change the macro state of the world from degenerating into one where investors will view the financial sector with great apprehension, uncertainty, and fragility risks. By coordinating as regulators to raise the capital level of the financial sector, while in the narrow it may look too punitive on an individual bank, it's going to benefit all banks, in my view, because we are altering the macro state of the world. I'll just stop there.
Let me just take you 1 minute more on the line, Viral, with a question that is precisely addressed to you and your somehow focus on the stress test and the importance of that. So one participant asked, what do you think would be the outcome of a stress test for banks in the euro area right now, if you would take account all the COVID-19 related costs and risk, as well as the pre-existing vulnerabilities, for example, in terms of low profitability? I mean, in a way, don't you think that running a stress test now, first of all, is still very difficult to ascertain the effect of the crisis and come up with precise estimate? And aren't you afraid maybe that we would show up too much weakness in a way in the system? Just in a few words so that we can go back to Sylvie as well.
Yeah, absolutely. I just go back to the EBA exercise of 2011 in March. We were in the same situation. It was a very fragile situation in the Eurozone. We were worried that declaring some banks as not being in great shape will be a problem. And we did not. Actually, Dexia, which was a bank that was in serious trouble, failed in 6 months after that, and we had ranked it as the 3rd best bank by regulatory capitalization. So I think we can't fool the market. I think regulators should give up on this notion that by simply not collecting information and disseminating it, I can maintain financial stability. No, if there is bad news, investors are going to seek it out. There are credit investors out there. There are equity investors out there. They want to know which banks are likely to survive and which banks won't survive. So I think the stress tests will reveal stress. I think there are some banks in all parts of the world which are not in healthy situation. They need to be fixed. We need to use bail-ins. We need to use resolution regime, and we need to use equity issuance wherever possible to recapitalize them as soon as possible. I think kicking the can down the road by saying right now we are in a stress situation is no way out, because stress can be worse always than where we are right now. And I think that's what we need to focus on.
Sylvie, you have been very close to the markets in your previous life, if you want. What do you think of this?
Well, in fact, I would agree with Viral that the market has to be treated as mature, because one way or another, at one point it will go out anyway. And in that respect, I mean, I don't know whether you have good or bad investors, as Francesco said. My expectation and my experience is that investors are, the main characteristic is that they are rational. And in fact, when they judge their investment, they make their own opinion on the profitability of the bank or the financial institution, on the perspective, on their positioning on the market, on their business model. And that's something that they hate, is when they are not able to foresee something, you know, something that is not, that they are not able to price, to predict. So uncertainty is the worst enemy of the shareholders. And if there is uncertainty, sometimes they would prefer not to get in, because in fact, it's something they just cannot factor in their own choice. So I guess my main perspective is that investors, shareholders are really basically rational, and they will not expect from their investment, if it was in a bad situation from an economic perspective, to take out a huge amount of dividends. So I mean, you need to be more flexible about what are investors today, because in fact, I guess the main characteristic is that they are rational. And then if Viral is right, is in some cases you need to ask some financial institution to raise more capital. I guess it will be a bad signal to say, well, I raise capital now, I want to see you and I want more capital now, but I'm not able to tell you whether you will be paid back and how much and when. So I guess it will not be it will be a tough sell on the market, to be honest. I have another question, maybe more for Francesco, which is related to the other tools. You mentioned why not additional tier one. Viral was saying that what is important is a level of capital which is kept within financial institution. And I was wondering, what about some macroprudential buffer, for example, pro-cyclical buffer, who were supposed to get higher when in good times in order to be able to be watered down when in times of crisis. I mean, it seems that everybody agrees that we are in time of crisis. So I would like to know what would be the attitude of the macroprudential regulator towards this type of measure, which in principle could go down in that time.
Francesco, Sylvie took my role as a chair, please.
Yes,
this is a very good question for you.
So thank you very much. So first of all, I say that we have been, if any, doing insufficient use of anti-cyclical instruments. So if there is something on which I'm unhappy, is that the countercyclical capital buffer for Germany was too low when the crisis came. That a number of countries which could have had a higher, so there were countries which had the maximum, okay? So Sweden has, and the Swedens of this world and this type of things have been releasing 2.5% of capital buffer instantaneously, so they have been playing all the macroprudential instruments have been playing all the role they could. In other cases, it was not a situation. And honestly, a lot of objections which are made today to what we are doing were done at that time when we were trying to increase the countercyclical capital buffer. Okay, so if the banks think about this experience, they should conclude on the fact that macroprudential authorities are able to release instantaneously, something which was a doubt. There was a doubt about it, first. Second, the banks themselves in this moment are not using the buffers. So the reality in this moment is that we are in a sort of an inverted world where we should send the supervisors to the banks to say, use these damn buffers you have in this situation. So it's a different business situation. So we have to reflect on how to do it. If the countercyclical buffers are not used in the moment in which we have released, we will have to think about replacing them with other buffers which will be fully structural. And I don't know whether the banks will be very, 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 very happy of that. In general, it's clear that the work which we have been doing in the last years has been helpful to the bank themselves. Imagine we would have entered into this crisis with capital levels which were much lower than the one which we had. So banks now can be unhappy because they cannot distribute the dividends. In the other situation, the banks would be basically queuing in front of the Single Resolution Board to try to find a solution. So all of these, to a certain extent, is an experience on which we have to reflect. The other things I wanted to say to Professor Krahnen is, we will see what will happen with history, but there are some large insurance which have been distributing. Okay, so the names are known. I don't need to say this, despite of the EIOPA and despite of the ESRB recommendation. I want to see what the market response will see. So if the market response were that rational, as you are saying, the market would punish them, because of course they've taken tremendous risks. They've taken tremendous risk in a situation in which for the next, so it is relatively, let's say, it is relatively easy to show ego now in a situation which is not yet as tragic as it could be in 1 or 2 years from now. From this point of view, I'm not sure whether there's not been people who have been trying, in fact, to play games, in the sense that they've been distributing now, if they could, knowing that in any case, we will not be able to distribute later on, because in a couple of months from now or years, there's nothing to distribute in any case. And honestly, I don't like it.
I think, I know we are over time. So if you, if we still have a few minutes, if you all have still a few minutes, we can prolong it. But do you still have a few minutes? Then we can at least let Jan reply, because I see he was very somehow wishing to do so. So please.
Yeah, no, just very brief. I think what the ESRB could do is to say, we don't want to go for bailout. And we do everything against it. And I think dividend restriction doesn't achieve much, if anything. A focus on resolution would do much more. The insurance company you were mentioning as a negative example, where you said, well, there should be a market reaction, will show a market reaction if there is not such a strong belief in bailout. And in a way, we always have this bailout idea in the back of our mind. And that is basically, in a way, it's the last act of a drama that we talk about, right? That's when we would restrict dividends and we would know there is no future. But there will be a future. And I don't believe that once you start to infringe on property rights of shareholders, the way you are suggesting, you will have no way to commit never to do it again. And markets will fully understand that is an industry where the rules are set by discretionary things. As somebody said in the discussion, we will always have a reason for defining a situation critical, and then this time it's not good for making dividends pay out, and that time not. And you take the responsibility in the end away from the shareholders and put it somewhere else, to the regulator. And I want to distribute the responsibility, the full responsibility with the shareholders. And they can distribute if they think they can survive. If not, they will go under, and we prepare for them to go under. That's our best role, I think.
Viral, very briefly, please unmute yourself.
Yes, 3 very brief points. First, I think equity comes first as a loss absorption buffer, even before bail-in capital, in my view. So I think just from the waterfall, I think equity has to bear the loss first. I think if we are at a stage where we are thinking of triggering in bail-ins, ideally we should not be distributing to shareholders, in my view. Second, I think whether we like it or not, I don't think no bailouts is a credible commitment that any regulator can provide. I think the best commitment you can provide not to do bailouts is to have adequate equity and bail-in capital. I fully agree, but I would say not just bail-in, it should also be adequate equity capital. And third and last point I would say is that I think this is an investment in future. when banks are undercapitalized, they don't lend well, even if they are bailed out. And I think this is what we have seen in Europe. This is what we saw in Japan in the 90s and 2000s, that undercapitalized banks, even when on a lifeline from the government, they simply don't lend. And I think I stress Sylvie's point here that when you are in a situation such as that one, there is so much uncertainty in investors' mind about the likely economic and financial outlook that the cost of capital for banks is very high. So if regulators can shore up capitals, reduce uncertainty, actually the cost of capital comes down for everyone in the system as a whole. Thank you.
But we have an overbanking system, right? You can't raise capital for everybody. This doesn't work. You have to get reduction in the banking side. So there must be exit, and that's the good time to have it.
Sylvie, your last words.
Okay, last word very quickly. First of all, I guess we should be all lucky that this crisis came at a time where all the capital buffers within financial institutions, and in particular bank, have been really increased. So in fact, the situation is quite different, and the financial sector today is in a quite good situation comparatively to what it was more than 10 years ago. So I think that's a good point, and that should be put to the credit of regulators and supervisors, and also shareholders, but first the regulators. Then my second point is that I really would like to avoid uncertainty. Because I guess when you have a regulation, it's all clear. I mean, you can discuss it before it's implemented, but when it's done, and everybody knows it. So in fact, the rules of the games are known and are clear. What I don't like in that type of recommendation of soft law is that the rules of the game are not clear, and people who play the game are not able to take that into account. And that I think it's a little unfair and may strike back.
Francesco, do you still want to have a final sentence, or we end?
We can end. I think we will have other occasions. History will say who was at least partially right. I don't think historians will say we were completely wrong.
No, that I don't think either. But I think it's an important point to take home, that one has to look also at the medium to long term, in my view, at least. So anyway, I'm very sorry that we have to stop. This has been a very exciting debate. Thank you to all of you. And we have a lot of questions from the participants. We will pass them on to you, and I hope we will have another occasion to continue this discussion. Thank you very much to everybody, and bye-bye.
Great. Thank you, everyone.
Bye-bye.